Howdy, everybody. Welcome to Liberty Call. Today is Thursday, October 10th, 2024. Hope you're having a fantastical day out there. It is a beautiful day here again in Colorado. A little smoky. We got some forest fires over off to, what did I do to my face? Got some forest fires off to the west, which are unfortunately making some rain, or some smoke in the air. Anyways, hope you're having a great day out there. If before we jump into the numbers, you could do me a favor, give me some thumbs up, a like, share, subscribe, follow, and press that notification bell. All righty. I'm not sure why the markets still show they're open when they should be closed. It is 2:08. All right, hang on. Stupid thing off my screen here. Hang on. Let me just turn that off. There we go. All righty. Let's go ahead and get that off the screen. Again, I don't know why the markets are still showing that they're open. Anyways, all right, well, let's go ahead and jump into the numbers. Dow Jones was down 0.14%, 57 points, closed at 42,454. S&P 500 down 0.15%, 8 points, closed at 57.83. NASDAQ down 0.04%, 7 points, closed at 18,283. The VIX was up 0.19% today. It's at 2090. Canada up 0.32%, Brazil up 0.31%, and Mexico up 1.1%. Let's pause that. All right, over in Europe, let's see here. Germany was down 0.23%, the UK down 0.07%, France down 0.24%, Netherlands down 0.48%, Spain down 0.72%, Italy up 0.43%, Switzerland down 0.27%, and Portugal down 0.28%. Russian exchanges both green today. The MOEX up 0.44%, RTSI up 0.14%. And the overnight markets, the Nikkei was up 0.29%, Australia up 0.43%, New Zealand down a third. In China, the Shanghai was up 1.32%, the Shenzhen component Shenzhen component down 0.82%, China A50 up 2.24%, China DJ Shanghai up 0.87%, Hang Seng up 2.98%, and the Taiwan weighted when it closed on the 9th was up 0.21%. All right, good stuff. All right, well, let's hop into the market recap. U.S. stocks fall as September hotter inflation muddies rate cut outlook. All right, U.S. stocks declined on Thursday following hotter than expected inflation data that dampened hopes for significant rate cuts from the Federal Reserve. The CPI, the Consumer Price Index, rose by 0.2% in September, remaining steady from August, but exceeding forecasts of 0.1%. Core CPI, excluding food and energy, increased by 0.3%, surpassing expectations of 2.3% and reaching an annual rate of 3.3%. This suggests the Fed may need to slow the pace of rate cuts, pushing the 10-year Treasury yield back above 4% for the first time since July. As the third quarter earnings season kicks off, focus shifts to major banks with JP Morgan Chase, Wells Fargo, Bank of New York Mellon set to report on Friday. Next week, Goldman Sachs, Bank of America, and Citigroup will release their earnings as well. Earnings from J&J, United Health Group, and Walgreens Boots are also anticipated. Delta Airlines shares dipped 0.3% as the airline released lower than expected fourth quarter guidance, citing challenges from a recent computer network outage and pricing pressures. GXO Logistics surged over 14% following reports that it is considering a sale, although no final decision has been made. Tesla remains stable as investors await the announcement of its robotaxi. AMD dropped more than 4% as it unveiled new AI and server chips at its AI event, including plans for a new M1325X chip slated for production later this year and additional AI chips to be released later in the year. Was that later in the year or later next year? Next year. All right, good stuff. Let's jump into some data. The September CPI, this comes to us via First Trust. Mr. Nate Guernsey put it together. All right, inflation remains stubbornly high in September as both headline and core inflation exceeded expectations, challenging hopes for a more substantial easing. Headline prices increased by 0.2%, slightly above the expected 0.1%, while the year-over-year inflation rate declined to 2.4%, marking the sixth consecutive month of decline. However, this drop has largely been due to falling energy prices, which decreased by 1.9% in September and have been down at an annualized rate of 10.6% over the last 6 months, with oil prices rebounding by about 10% in early October due to heightened Middle East tensions. Energy could soon exert upward pressure on inflation again. Core inflation, excluding food and energy, rose by 0.3%, bringing the year-over-year rate to 3.3%, the highest in 4 months. Housing rents, which increased by 0.4%, have significantly driven core inflation, and they show little sign of slowing. Additionally, a measure called supercore inflation, which excludes food, energy, goods, and housing rents, rose by 0.4% and has increased by 4.3% over the past year, up from 3.8% a year ago. These figures indicate that inflation remains above the Fed's critical 2% target for the 43rd consecutive month. While some easing may occur as the Fed continues its tight monetary policy, it's more likely that the central bank will opt for a more modest quarter-point rate cut following the upcoming election. In other economic news, initial jobless claims jumped by 33,000 last week to 258,000, the highest level this year, partly due to disruptions from Hurricane Helene and a recent dock workers strike. Continuing claims also rose by 42,000, reaching 1.861 million. All right, so that's the CPI and the jobs data. Got one more article here before we finish up for the day. It comes via Zero Hedge. Is the Fed asleep at the wheel again? This was put together by Deval Joshi, chief strategist at BCA Research. All right, in his analysis, Deval of BCA Research suggests that while recent robust U.S. employment data eases recession fears, it has stoked inflation concerns, complicating the Federal Reserve's decision-making. The strong jobs report implies that aggressive Fed rate cuts could fuel inflation rather than stabilize it. Joshi notes that traditional recession indicators, like the Joshi and SOM rules, have recently backed away from threshold signaling downturns, which is unusual. Instead, the U.S. economy seems to be driven by supply rather than demand, suggesting that recessions may not be imminent. To maintain inflation at the Fed's 2% target, wage inflation would need to cool to around 3%. However, the current job vacancy rate suggests wage inflation could remain elevated. Inflation expectations have ticked up, and Joshi argues that significant rate cuts may unmoor inflation expectations from the Fed's target. He suggests that in the absence of a recession, the greater risk is not to profits, but to stock valuations, as Fed rate cuts are unlikely to be aggressive or as aggressive as the market currently expects. Joshi advises against betting on steep rate cuts and recommends holding short positions in the February 2025 Fed funds futures and 2-year U.S. Treasuries. He also advises going long on U.S. dollar over the British pound, as the Fed's slower rate cuts may strengthen the dollar. Regarding stock market strategies, he suggests favoring undervalued small caps over high-valued tech stocks and non-U.S. equities over U.S. ones. He also recommends a counterintuitive short position on gold, arguing that the anticipated dollar strength could diminish gold's value with an 8% profit target and stop loss on a 6-month horizon. All right, so those are his suggestions if things pan out the way he thinks. So do with it what you will. All right. Well, that's everything that I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. That's where you can go get all your financial planning needs addressed. So feel free to give me a buzz. All right. Well, hope everyone has a wonderful evening, and I shall talk to all y'all again next time. Adios.